Good morning and welcome to this week's edition of the Breakfast Club for Women Entrepreneurs. My name is Lynn Sock. I'll just wait a couple of minutes to see if anybody pops in. All right, so I'm just going to jump into it right away today. Today's topic is 4 year-end tips for sole proprietors. Today, I'm specifically focusing on sole proprietors, those who are self-employed. It's that time of year where a lot of people contact me and talk about their business finances, and they start planning for 2025. Question that always comes up is, as a sole proprietor, as someone who's self-employed, how can I reduce my taxes? So I'm going to get into 4 tips, but before I do, I just wanted to do an overview of what it means to be self-employed, because I find that it's not explained well, and even if you look it up online, sometimes it's kind of piecing together lots of bits and pieces of information and not knowing what applies to you and not knowing what's true. So definition of a sole proprietor or someone who's self-employed is basically, typically, if you're running under your own name. Now, here in Quebec, you could choose to register as a sole proprietor, otherwise known as an entreprise individuelle. An entreprise individuelle is basically your designation when you register your business on the Registre des Entreprises du Québec website. The fee is about $40 or something along those lines. And what happens is that when you register, you pop up in the public list for the Registre des Entreprises. You are allowed to operate under your own name, and that listing stays on as long as you keep updating your filings every year. Anybody could do this, and you work under your own name. Now, technically in Canada, you don't need, or if you're living in Quebec, you don't need to register on the Registre des Entreprises. You could go ahead, as an example, let's say today I decided I want to start a photography business and I'm operating under my name, Lynn Sock Photography. And let's pretend the month of December, because it's busy, there's a lot of families doing Christmas photos, I make $20,000 in the month of December. Woohoo, everything's great. When April comes around and I file my personal income taxes, technically I could declare that income on my personal income taxes. I didn't have to register on the Registre des Entreprises. I could just go ahead and fill out what's called the Statement of Business or Professional Services, which is the T2125 form when you file your personal income taxes. I could declare my business revenue there as well as my expenses there. I didn't have to register on the Registre des Entreprises. I could just go ahead and do it. So this is a little bit of gray area, and sometimes I see online. You don't have to register as an entreprise individuelle here in Quebec. You could just go ahead and file your self-employed income taxes when you file your personal income tax return. I always recommend that you do register on the Registre des Entreprises, because for the general public who doesn't understand, no, I don't want to say that. For the general public, they may try to search you up on this website to see if you're legitimate. But just because you're on this website doesn't mean that you run an ongoing business. You could just simply renew every year, and your listing is there. So that's basically what it means to be self-employed or a sole proprietor. During this session, I will refer to that business structure as both entreprise individuelle, self-employed, sole proprietor. You're all basically filing the same income tax form when you file your personal income taxes. When you're self-employed, there's no differentiation between your personal income taxes and your business. It's all done on the same T1 general form, your personal income tax filings. The difference is there's an extra document that needs to be filed, which is your T2125. That's where you declare your business revenue. That's where you declare your business expenses. I see some people are here. I'm going to, if anybody wants to show their face and be on video with me, with StreamYard, it is a different link. So I'm going to put the link in the chat. You could simply copy, paste it, put it into another browser, and I'll let you come on if you would like to show your face and interact. So again, just kind of doing a little bit of self-employed finances 101. It's important to remember that what you bring into your business needs to provide enough revenue for everything for you. So the revenue you bring into your business needs to pay for your business expenses. Question in the chat: what if I'm a sole proprietor and not registered? I'm not sure what the question is. You just redefine the question, what you mean by what if you're a sole proprietor and not registered, and I'll answer that question. The income that you bring in, the revenue that you bring in, has to pay for everything. It has to pay for your business expenses. It has to pay for your income taxes. Your business revenue needs to pay for your personal living expenses, your groceries, your car, your gas, your hydro, etc., etc. Your business revenue needs to pay for your personal and business cash flow and savings. So whether you work for a company or you work for yourself, you should always be putting money aside and creating cash flow for yourself, right? The whole idea of saving for a rainy day. You should also bring in enough revenue to pay for your retirement. When you work for a company, you could either work for a company that provides these benefits for you. So some people work for a company that have a group insurance and maybe a group retirement plan. So it's kind of done for you. When you are a business owner, sole proprietor, self-employed, incorporated, whatever it is, when you own a business, you need to do that for yourself because you are your own employer. So this is where I find a lot of sole proprietors lack. Especially in the last few years, many people have transitioned from corporate to owning their own business, and they forget that they still need to create cash flow and plan for their retirement as they're making their income. So top view looking down, just remember that all your business revenue needs to pay for everything, just as if you were working for somebody else. If you are working for a company, you want to make sure that you take home enough money to pay for your expenses. There's your gross salary, which is whatever it is, 75,000, 100,000, 150,000. With that gross revenue, you're paying income taxes. You might be paying for a group insurance plan. You might be paying for a group pension plan or a retirement plan. And then whatever's net of all that pays for your personal living expenses, and hopefully you're putting money aside. So what are the, and just to get back to Afrina's question, if you could define what, I'm not sure what the question is. So if you could just redefine what you mean from your question, and I'll answer it for you. So what are my 4 tax tips for sole proprietors year end? Number 1, when you're planning for next year, you should be planning from September, October moving forward. So Q4 is when you start planning for the following year and kind of wrapping up your year. Don't wait till the last minute. Just like anything else in life, it's hard to, procrastination is not good for anybody, but also because if you need the advice of experts, you can't wait until December, January, February. These are the worst times to meet with a financial advisor, financial planner, or an accountant, because that's our super busy period. So if you want any tax strategies or how to close out your year end and what to declare, what not to declare, if you have outstanding invoices, and you might want to take a look at, should I push to get paid this year or next year, things like that. It's best to start in September. It's best to start your closing out your year in September and also planning for the following year. So September, October, November, December. That's when you should start. Never wait till the last minute, because most of us professionals that you would need to be in contact with, we're super busy and we don't have the time to do emergency tax planning. So I know for myself, as a rule, when it comes to business owners, I try to do all of my tax strategies and whatnot October, November, December. This is usually booked ahead of time. I do not, unless it's an emergency, and if I have time, I try not to do anything January, February, because that's our RRSP season. Everything's normally done before, ahead of time. I mentioned RRSPs. That's the second tax tip. So you may have heard that as a sole proprietor, it's a good idea to lower your taxable income by making RRSP contributions. What's important to understand is that your RRSP contributions does not dollar for dollar reduce how much money you owe in taxes. This is a misconception that I see out there, and I've even seen posts from financial advisors or accountants who, I don't think they're doing this intentionally. I think they're just not explaining it right. I've seen incorrect information online that if you want to reduce your taxes as someone who's self-employed and you contribute $5,000, let's say, to an RRSP, that reduces your income tax owing by $5,000. That's not what happens. What happens is it reduces your taxable income by $5,000. And yes, it does reduce how much you owe in taxes, but it does not reduce the amount of money that you owe in taxes dollar for dollar. A $5,000 contribution to RRSPs does not reduce what you owe to the government in taxes by $5,000. So very important. However, contributing to RRSPs or contributing to maybe TFSAs, whatever it is that you need for retirement, is still a good idea, because I'm going to go back to what I started off with, which is whatever your business revenue brings in, it needs to pay for all the things that you need, including paying for retirement and including creating a cash flow. RRSP contributions are an excellent idea, but you need to plan for them. You need to plan for them, and you need to understand that it does not reduce how much you owe the government dollar for dollar. What it does is it reduces your taxable income. So how much your taxable income is basically all your business revenue minus your business expenses. And if you make any RRSP contributions, this reduces that amount by however much you contribute. That amount becomes your taxable income. So I'll use an example. Let's say we're 2024 and you're expected to make $100,000 in gross sales this year. So and I'm going to use roundabout numbers. So let's say based on $100,000, your business expenses are $10,000. So now your taxable income is reduced to $90,000, and what you owe the government is income taxes based on $90,000 of taxable income. But now you say to yourself, you know what? I also want to contribute to our RRSPs. I want to contribute $10,000. So now you've reduced your taxable income again by another $10,000 to $80,000. So the money that you owe in income taxes, instead of it being $90,000 of taxable income, it's $80,000 of taxable income. So you reduce your taxable income and you're putting money aside for retirement. And because you've made an RRSP contribution, when you file your income taxes, you'll receive some money back for that contribution. So look into making RRSP contributions. Most of my self-employed clients, because their income is sporadic, what we try to do is set up a situation where it's either they're contributing to their RRSPs regularly throughout the year, or if that's not possible, or if you work in an industry where income is really sporadic, sometimes we go with our RRSP loans. That way, we could kind of guesstimate how much you need to contribute to your RRSPs for it to financially make sense, instead of just coming up with a random number to contribute to your RRSPs. So RRSP contributions are important. Just remember that how much you contribute does not deduct dollar for dollar what you owe to the government. The third thing when it comes to year-end tax planning for sole proprietors is planning for future life milestones. And I'm going to touch on two major milestones because it keeps coming up over and over. So the first thing is, for any of the ladies here who are, or if you know anybody who are planning to go on maternity leave, are planning to have a baby. As someone who's self-employed, you don't automatically contribute to GPIP, which is the Quebec Parental Plan, maternity leave, parental leave program here in Quebec. When you are a salaried employee, it's an automatic deduction. But when you are self-employed, it's not an automatic deduction. So if you find out that you're pregnant today and you haven't contributed to it yet, then you're not going to be eligible for maternity leave. This is something that needs to be planned in advance. as you are tax planning for the future. So super important. It doesn't happen automatically. You have to request it. The second thing that you need to plan ahead for is a mortgage. So I work with a lot of mortgage. I work with mortgages, and one issue that I've seen a lot of this year is either people who are self-employed who are renewing their mortgages, or people who are self-employed and are looking to buy their first home. When you are self-employed, yes, you can qualify for a mortgage, but the income that we use in order to qualify you is the average of the last 2 years, the taxable income of the last 2 years. So if you were applying for a mortgage today and you wanted to qualify for a regular standard mortgage loan, we would be looking at the average of your 2022 taxable income and 2023 taxable income divided by 2. This is important because some accountants who don't plan strategically, what they tell their clients is deduct everything when you file your income taxes, and that way you'll pay less taxes. Yes, that's true. But if you deduct so much in deductions, and I know I've seen accountants deduct things that they really shouldn't. I'm not saying all of them are like that, but if you deduct too much and you wind up with taxable income of, and I'm just going to make this up, of $10,000 in 2022 and $10,000 in 2023, guess what? I'm supposed to qualify you on a mortgage based on $10,000 of income. You're not going to get anything with that. So if you are planning to purchase a home and you are 100% self-employed, or if you have a mortgage renewal coming up in the next couple of years, and you want to look around at your options and maybe not stay with the same lender that you're with, you have to make sure that your last 2 years of tax filings reflect a decent salary or a decent amount of taxable income so that you qualify for something halfway decent. And again, this is planning for the future. So this idea, a big mistake that I see people make is, again, getting false advice. That it's not that it's false advice, but it's not strategic tax planning. This idea that deduct everything so that you pay less taxes. But if you're deducting everything and you're only showing that you make $10,000, $20,000, it's not going to make sense. Logically speaking, even without understanding finance or taxes, logically speaking, if you're only making $20,000 a year, you're not going to be able to afford a mortgage. Like, that's just in conversation at a social event. So imagine asking a lender, it's not going to fly. So if your mortgage is up for renewal in the next few years, or if you're planning on buying in the next few years, make sure that as you're closing out 2024 and you're planning for 2025, that your taxable income is a respectable amount depending on what it is that you're trying to purchase. And the last thing that I want to mention, in terms of tax tips for sole proprietors, is it's not so much a tax tip, but more of business financial planning. When you're future projecting for the following year. So around this time, I know that for me, I've already looked at my business numbers or projected my business numbers for next year. When you're future projecting for the following year for your business, aim to increase your revenue by 25%. Now, some people might say, "Oof, 25%, that's a lot." Aim for 25%, and that way, if you fall short, you'll be a little less. And the reason why I say that is because when you're self-employed, you're literally working for yourself. And in the first few years, you might be super happy, you're excited, you're a brand strategist, you're a web designer, you're a team of one, you're so happy, you don't work in a corporate environment anymore. You probably posted it on social media that you left your corporate job and now you're full-time self-employed. That's fantastic. But what happens is, as you get into entrepreneurship and freelancing and being self-employed, years go by, you get tired. And I'm telling you this from experience. You get tired and you realize that you're stuck to your business if you're a team of one. The minute you want to start scaling, the minute you want to start outsourcing, you need to make sure that your business revenue can sustain that. I'll use an example. Again, let's say this year I make $100,000 a year. I'm team of one. I don't have any assistants. I do everything on my own. This is usually how freelancers, sole proprietors start off at. But let's say I don't aim to increase my revenue by 25% every year. My goal is every year I want to make $100,000. If let's say a couple of years from now, I don't want to do my social media anymore. Now, social media, if you hire a social media content creator, that could easily cost anywhere between $1,500 to $2,500 a month. That's a big chunk of money that you would need to shell out to hire somebody. And imagine if I didn't increase my revenue by 25% every year, it's eating away at my own revenue. So that's why I say when you future project for the following year, aim to increase your revenue by 25% to allow yourself that cushion to do things like delegate, to outsource, to scale and to grow. You want to hire as an assistant? No problem. But if your revenue is not going up year over year, guess what? You're paying your assistant out of the money that you should be keeping for yourself. Because I've seen this over and over again where people say, well, you know what? I'll hire an assistant. I'll hire a social media content creator. It's an investment. And by hiring them, they're going to generate more revenue for me. That's a great idea, except that I know in reality, it doesn't always happen like that. What ends up happening that it's just an expense. It's an expense and it eats away at the money that you're putting in your pocket to pay for all the stuff that you need to pay for out of your business revenue. It cuts into paying for other business expenses, your income taxes, your personal living expenses, your savings for both your personal and your business, and it also eats away at what you're putting aside for retirement. So when money is tight as a business owner, what do? You probably stop putting money aside for savings, regular day-to-day savings. You probably stop putting money aside for your retirement. You have to cut down on your living expenses. So when you are planning for the following year, it is still related to taxes, but it's really for your overall finances. Aim to increase your revenue every year in your business by 25%. And if you fall short, you fall short, but aim high so that at least if you come short, you might come, if you come short, it's okay because you're aiming high. I hope that makes sense. To close out, look, the end of the year is coming. We only have 1 month left. One thing I forgot to mention is if you're looking for another way to reduce your taxable income, charitable donations are also a great way to reduce your taxable income because you're issued a tax receipt. Just make sure that you're donating to a registered charity. This is also another way, like if you have a cause in mind, a local community center or an organization that touches your heart, this is a way that you could do it. If you can, set it up on a regular basis throughout the year so it's not just one lump sum at the end of the year. Tax planning should be done ahead of time. I've already done mine for 2025. So if your fiscal year is the calendar year, like I said, it should start at the beginning of Q4 because it does take time. If you're going back and forth between your accountant and your financial advisor to try to figure out how we're going to do this, maybe you're thinking of incorporating. That also takes planning to see if it's a good idea to incorporate or not. Start at the beginning of Q4 so that you start off Q1 of the following year on the right foot. I had mentioned in one of my posts that I would touch on incorporation because this is also another big question as a sole proprietor. Is it time to incorporate? The other big myth that I see online is that the minute you start making $100,000 a year in revenue as a sole proprietor, you should incorporate. That's a big lie and it's a big misconception. It has nothing to do with your revenue. It has to do with your cash flow. So when I started this session, I mentioned that all the money that you bring into your business has to cover everything in your business and everything in your personal. You want to make sure that you have all of that covered first and before you even think of incorporating. Because the goal of incorporating, yes, is to save on taxes, but you need to have the cash flow for it. There are tax strategies that we use, and you could reach out to me privately if you want to talk about it further. But if there are tax strategies you could use under an incorporation only if you have money in there. rule of thumb, if whatever money you're making in your business, if you're taking it all out, if you're using all of it, both for business and for personal, not a good time to incorporate. Incorporation is really for people who have excess cash flow. They check off all the boxes when it comes to their business and personal financial planning. And they have this set of money that always seems to be there with nothing to do and nowhere to place it. That's where it's a good idea to think of incorporation. Also, is this a business that you plan on keeping for long term? If it is, then it's excellent. And when I say long term, typically at least 10, 15 years. Or is this kind of a business that you started and it's a little bit fly by night and you're keeping the business for a couple of years until, the next milestone in life? So again, general rule of thumb, if you're thinking of incorporating, make sure you covered all the bases, all the basics when it comes to business and personal finances. So paying for your expenses, paying for your income taxes, make sure you cover your living expenses, make sure that you're able to put aside money for cash flow, make sure that that you have enough money to pay for retirement, make sure that you have disability and critical illness insurance. If your business doesn't generate enough money to at least do that, don't even think about incorporation, because what's going to happen when you incorporate and you don't have enough revenue coming in? Then basically you've paid to set up an incorporation, you're paying more to do your tax filings, and you can't take advantage of the tax strategies. So it's super important. If you want to kind of roundabout numbers, you could always reach out to me. As a sole proprietor, as a business owner, make sure to have a good financial advisor, and remember to have a good accountant working with you where you can ask these questions. What's a good financial advisor and what's a good accountant? Someone who's going to strategize with you. And it's not everybody who's going to do that. I still touch on it as a financial advisor, but I have a team now. So if anybody wants more information, reach out to me. But it's quite possible that you're not going to be working with me. You might be working with someone on my team. Same thing with an accountant. There are accountants who are just tax filers. You meet them once a year, you give them all of your receipts and your invoices, they file your taxes, sign here, pay me, and they send it off to the CRA in Revenue Canada, Revenue Quebec. If you want to tax plan, you need an accountant that will tax plan with you. And if you have an accountant that does tax plan with you, typically they're not going to do it during high season, which is end of year, January, February onwards. The best time to do it would be like around September or October. If they're still in town, I know a lot of them go on vacation during that time. So I hope this helps. I don't know if Afrena, you're still there, but I didn't see a follow-up question. I wasn't sure what you were asking. If anybody has any questions, or if you need an accountant referral, if you want to discuss our RSP contributions, how much do you need to contribute to an RSP for it to make sense? Feel free to reach out. My email address is there. And like I said, if it's not me who's assisting you, I have someone on my team will reach out to you in order to discuss what's needed for your business. So I know we're falling short, 10:30, but I wrapped up everything. Happy end of year, everybody. Let's close out 2024 and make sure you aim for 25% more revenue in 2025 so that you could continue and grow. My question was for the forms being filed. It's the same form. It's the same form. It's a T2125. Claiming deductions in a way is disadvantageous, as when you sell a property or recapture a previously yearly claimed deductions get calculated and added to your capital gains, therefore increasing your taxes you need to pay out. So real estate investment isn't a good idea. Not necessarily. I'm not saying that I'm saying that claiming deductions could be disadvantageous, but it depends from situation to situation. So for real estate is a little bit different. It also depends what type of property, how long you've had it, how much capital gains we're looking at. These are all calculations and need to be discussed case by case. And this is in collaboration with, usually it's your accountants first. Your accountant should be able to figure out what the estimated capital gains is and then work backwards from there. So it's not that deductions are disadvantageous. This is where tax planning comes in. And if you have real estate, if you have rental properties, for sure there's going to be some type of capital gains, but how much depends on property to property, depends on how much the value of the property is increased, and etc. How much would you budget for a financial advisor or accountant? So myself, my services are free to clients. I get paid by the financial institutions that I work with. For accountants, it depends. If you are a sole proprietor, I think the lowest that I've seen is around the $300-400 mark, right up until almost $1,000 as a sole proprietor. Whether you're a sole proprietor or incorporated, if you work with a CPA, they will charge you more, generally speaking. Once you incorporate, you're probably looking at least about $1,200-1,500 for tax to file your income taxes, because accountants usually charge based on how many forms need to be completed. So the more forms that need to be completed based on your situation, the more expensive it is. And again, if you need a referral, let me know. Any other questions? Awesome. So listen, have a great weekend, everybody. I know some of you I might see tomorrow at our Christmas party. Other than that, Tuesday, we're going to be talking about choosing the right life insurance for anyone who's looking for life insurance and doesn't understand the different options. And next Friday, we're going to be talking about goal setting for 2025. I did an in-person workshop a few weeks ago, so now I'm doing it online, and that's going to be next Friday. Thanks so much, everybody. Have a great weekend.